The impact of market sentiment on cryptocurrency. The cryptocurrency market, often volatile and unpredictable, is deeply influenced by market sentiment. Market sentiment refers to the prevailing mood or attitude of investors and traders toward a particular asset, class of assets, or the overall market. In the context of cryptocurrency, market sentiment can be bullish, optimistic, bearish, pessimistic, or neutral, and these sentiments are shaped by a complex combination of factors. These include news developments, social media trends, macroeconomic events, technological advancements, regulatory changes, and even the opinions of key influencers within the industry. This video explores how market sentiment impacts the cryptocurrency market, highlighting the relationship between sentiment and price fluctuations, investor behavior, and the overall evolution of the digital asset ecosystem. Cryptocurrency is often considered to be a speculative market, with investors driven by emotions rather than fundamental analysis. This emotional investment is largely due to the market's high volatility. Unlike traditional financial markets, which are influenced by economic data, corporate earnings, or geopolitical events, cryptocurrency prices tend to fluctuate sharply in response to changes in investor sentiment. In fact, market sentiment can sometimes be the driving force behind price movements, rather than underlying market fundamentals. For example, a sudden surge in positive sentiment, driven by a favorable news report or a prominent individual's endorsement, can lead to a sharp increase in prices, whereas negative sentiment, fueled by concerns over regulation or security issues, can result in a rapid decline in value. One of the most significant ways in which market sentiment influences cryptocurrency is through price volatility. Cryptocurrencies such as Bitcoin, Ethereum, and smaller altcoins are notorious for their wild price swings, and these fluctuations are often triggered or exacerbated by shifts in sentiment. The impact of sentiment on price is often amplified due to the relatively small size of the cryptocurrency market compared to traditional financial markets. This means that even small changes in sentiment can lead to disproportionately large price movements. For instance, in December 2017, Bitcoin's price surged to nearly $20,000, largely driven by a wave of positive sentiment spurred on by mainstream media coverage, speculation, and the launch of Bitcoin futures contracts. However, in the months that followed, as market sentiment turned sour due to regulatory concerns and market manipulation fears, Bitcoin's price plummeted, losing over 80% of its value by the end of 2018. Social media plays a crucial role in shaping market sentiment within the cryptocurrency space. Platforms like Twitter, Reddit, and Telegram have become key battlegrounds for the spread of information and sentiment. Influential figures, such as well-known investors, entrepreneurs, and even celebrities, can have an outsized effect on market sentiment through their social media posts. A single tweet from Elon Musk, for example, can trigger dramatic price movements in cryptocurrencies like Bitcoin and Dogecoin. Musk's tweets regarding Dogecoin, in particular, have been associated with both sharp rises and falls in the coin's value. Similarly, Reddit's Wall Street Bets forum, which gained notoriety during the GameStop short squeeze in early 2021, has also become a place where cryptocurrency enthusiasts rally around certain tokens, influencing sentiment and price behavior. This social media-driven sentiment can result in both positive and negative feedback loops, where a surge in sentiment leads to further price increases, creating a self-reinforcing cycle, or where negative sentiment causes a cascade of selling, driving prices lower. The psychology of the market also plays a crucial role in shaping cryptocurrency sentiment. The herd mentality is a powerful force in financial markets, and cryptocurrencies are no exception. When investors see others buying into a particular asset, they often feel compelled to join the trend, even without fully understanding the asset's fundamentals. This behavior is particularly pronounced in the cryptocurrency market, where FOMO, fear of missing out, can lead to mass buying during bull runs. Conversely, when the market turns bearish, investors may panic and sell off their holdings, further driving prices down. This psychological aspect of the market is amplified by the inherent volatility of cryptocurrencies, creating a feedback loop that can result in extreme price swings. For example, during the 2017 Bitcoin bull run, many retail investors piled into the market driven by FOMO, only to exit during the subsequent crash, exacerbating the downward pressure on prices. The media also plays an essential role in shaping market sentiment. News outlets, both mainstream and niche, often report on developments that can have a significant impact on the cryptocurrency market. Positive news, such as institutional adoption of Bitcoin or the introduction of favorable regulations in key markets, can spark a bullish sentiment, while negative news, such as security breaches, regulatory crackdowns, or government bans, can trigger bearish sentiment. A particularly noteworthy example is the media's reaction to China's regulatory actions against cryptocurrency mining and trading, which led to a substantial drop in Bitcoin's price in 2021. As China moved to shut down mining operations and crack down on cryptocurrency trading, market sentiment turned sharply negative, and the price of Bitcoin fell from its all-time high of over $64,000 in April 2021 to below $30,000 by June of the same year. Regulation is another critical factor influencing market sentiment in the cryptocurrency space. Governments and regulatory bodies around the world are still grappling with how to approach cryptocurrencies. The lack of clear and consistent regulations creates uncertainty, which can significantly impact sentiment. For instance, when a country announces a crackdown on cryptocurrency trading, or when a government threatens to introduce restrictive regulations, it can cause panic selling and a sharp decline in market prices. Conversely, when a country adopts a more favorable stance, such as recognizing Bitcoin as legal tender, it can generate positive sentiment and contribute to a bullish market environment. El Salvador's decision to adopt Bitcoin as legal tender in 2021, for example, was seen as a major victory for the cryptocurrency space, leading to a surge in market sentiment and a brief increase in Bitcoin's price. Technological advancements within the cryptocurrency ecosystem also play a significant role in shaping market sentiment. Innovations such as the development of decentralized finance, DeFi, non-fungible tokens, NFTs, and Layer 2 solutions like the Lightning Network have attracted considerable attention from investors and have positively impacted sentiment toward cryptocurrencies. For example, the explosive growth of DeFi in 2020 and 2021 generated a surge in optimism about the future of blockchain-based financial systems, which contributed to a positive market sentiment and rising prices for many cryptocurrencies. On the other hand, technical issues, such as network congestion or security vulnerabilities, can have the opposite effect, leading to a decline in sentiment. The Ethereum network's congestion issues in 2021, for instance, led to frustrations among users and developers, which temporarily dampened market sentiment for Ethereum and its associated projects. Investor behavior is another important consideration when analyzing the impact of market sentiment on cryptocurrency. The relatively young and inexperienced nature of many cryptocurrency investors, combined with the allure of quick profits, often leads to a more volatile market. Many investors in the cryptocurrency space are attracted by the potential for high returns, but this can also lead to irrational decision-making driven by emotions. When sentiment is overwhelmingly bullish, investors may overlook the risks and enter the market without fully understanding the assets they are purchasing. Conversely, during periods of negative sentiment, investors may become overly risk-averse and abandon the market entirely, even if the long-term prospects of cryptocurrency remain strong. This short-term thinking can exacerbate market swings and contribute to the overall volatility of the space. Market sentiment is a crucial factor in determining the direction and behavior of the cryptocurrency market. The complex interplay of emotional drivers, social media influence, media coverage, regulatory developments, and technological advancements all contribute to shaping investor sentiment, which in turn influences prices and market dynamics. The volatility of the cryptocurrency market is amplified by the psychological factors at play, with herd behavior, FOMO, and panic selling often leading to sharp price fluctuations. As the cryptocurrency space continues to evolve and mature, understanding the role of market sentiment will be crucial for investors, traders, and regulators alike in navigating this dynamic and rapidly changing market. The future of cryptocurrency may depend not only on its technological innovations and adoption but also on the broader sentiment and confidence in the market as a whole.